Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates and 10-year note yields still elevated since rising above 240 back on December 19th. So we haven't seen a day below 240 since then, and the market is sort of extending the old range. Recall we had 10-year note yields trading between 230 and 240. We did see a few pops above 240 that didn't last more than a blink of an eye, and now we've obviously pushed through there and we've remained above there. So we've really extended this recent range from 230 to 250 now, as we are hovering back towards 240, but have yet to go back below it since that first trade through. And volatility, while we did see a little bit of a move higher as the market extended the range, it has since come back down. It looks to be trending back towards year-to-date lows as we head into the end of 2017 tomorrow. But I think that right now it's really a non-event. Volatility is not going to be something that we talk about at least until next year. And as we've seen lower lows going back even to 2016 and 2000, it just keeps going lower and lower, and the market just is very complacent. The Federal Reserve is still very much involved in the bond market, and I think those two go hand in hand. So as long as the Fed remains with their hand in the cookie jar, so to speak, volatility will remain low. We will have moments, as we've seen in the past, moments where we do volatility elevates, but it quickly reverses. So what's next week? Let's not talk about, we've had all the data we're going to have for pretty much for the end of the year. Tomorrow is a shortened session. Next week we get a full, really, it's a shortened week, but we have a lot of data coming in. January 3rd, we get the FOMC minutes from the December meeting. Now, this was Janet Yellen's last press conference. It was perceived to be a meeting where she sort of laid out the groundwork for next year. Where, they're going to continue to monitor inflation. They're going to continue to raise rates slowly, and that is going to kind of carry over. I don't see any real surprises. However, we have seen bigger trading days on the minutes than on the actual meetings themselves. So that's something to keep in mind. And secondly, we have employment. Employment, for the December, it could come in, or expecting numbers to come in rather on the norm. I don't expect this to be a big or a small number, but of course that's when things get sort of thrown off the tracks. So we have employment and we have FOMC minutes next to really kick off the year. So a lot can happen between now and next Friday. The market is trading within a pretty good range. The range has widened, but it is still trading right in the middle of it. So a lot of wiggle room on either side. And if we do see a breakout trade in 10 years, we're going to see yields get above 250 or below 230. Two things that may not happen next week, but certainly we have the ammo and the news and the events to do it. Likewise, we're kicking off a new year. So we've seen positioning get a lot of leverage funds getting very short. So they are anticipating higher yields, which typically means the opposite will happen. So look for yields to probably creep lower into next week, but we'll have the data, we have the minutes, a lot of that will take care of itself. This is Todd Colvin coming to you from the floor of the CME Group.